How about I borrow money for 4% interest and invest it for 10%? Is this a good idea and should I do it? This is something a lot of you have asked, so here's a video where we will dive deeper into leveraging P2P lending portfolios. Today you will find out whether it's a good fit for you and what you should pay good attention to before even considering taking a loan and investing it in other loans for a higher interest. I'm your host Jakub from P2P Empire, and if your goal is to become a more educated P2P investor, consider subscribing and also hit the like button to see more videos like this in the future. So the idea of leveraging your P2P lending portfolio is quite straightforward. If you have been investing in P2P loans for a while and your experience is positive, you might think about taking a cheap loan and invest it into high-yielding loans. The best way to show you the potential yield and the associated cost is by calculating it. So here is a representative example. So let's give you first a better understanding of the investment case. So let's say you have 50,000 euro of your own money, which you plan to invest for the period of 5 years. The interest for your loan is in this case being repaid on a monthly basis, and all your earned yield is being reinvested. To increase the potential return, you will take another 50,000 euro loan for 5 years for an effective APR of 4%. The loan as well as the interest is being repaid on a monthly basis. To calculate the yield, we have entered the data into a compound interest calculator, and we used a different calculator to calculate the APR for the loan. Please take this example with a grain of salt. Obviously, not every investment loan pays out interest every month, and if you take a full bullet loan instead of an annuity loan, the interest will be also different. Alright, so in this table you can see the investment amount every year together with the earned interest, which is represented as annual yield. In the next column you can see the interest rate which you have to pay every year for your loan. It's basically the sum of all monthly interest payments in a 12-month period. Please note that the outstanding loan amount is decreasing every month, so the interest rate is obviously also lower every year. What you should be also aware of is that typically you have to make loan repayments every month. In this example actually, you have to pay monthly interest as well as repay 833 euro of loan principal to repay the loan after 5 years. In order to fully benefit from the leverage effect, you need to repay the loan from other income sources and not rely on the income from your P2P investments. Withdrawing the loan repayment from your P2P portfolio every month would likely not be possible, as P2P investments are typically not as liquid, especially not those that earn 10% interest per year. Leveraging a P2P portfolio would therefore make more sense only if you have enough available cash flow per month comfortably repay the loan. So now you have the annual yield, the cost for the debt, and what's missing are the taxes that you need to pay on your yield every year. The tax rate depends obviously on your tax legislation. For representative purposes, we will take into consideration the legislation in Germany, where the income from capital gains is tax-free up to 801 euro per year. Any additional income from capital gains is taxed with a tax rate of 25%. So by leveraging your portfolio with another 50,000 euro over a 5-year period, with an annual average yield of 10%, you will make in total 64,531 euro. The cost for your loan will be 4,990 euro, and the taxes on your yield will be in total 15,132 euro. The net return of this strategy is 44,410 euro with a debt to equity ratio of 1 and return to equity of 20.94% per year. If you would not leverage and invest only 50,000 euro without any additional monthly investments, you would make a total yield of 32,265 euro and pay 7,065 euro in taxes. The net return after 5 years would be 25,200 euro with an annual return on equity of 10.65%. So by leveraging your portfolio in this scenario, you would increase your wealth by 19,210 euro over 5 years. Alright, now you might be wondering, when does it make sense? Well, it could be an option if you have a solid monthly cash flow and you plan to invest a fixed amount of around 833 euro a month over the next 5 years. If you would execute this strategy, you would make a gross return of 46,791 euro after 5 years. That's the yield from your investments. After deducting the taxes of 10,697 euro, your net profit will be 36,095 euro. So with the leverage, your net profit is 44,410 euro, and without it, it's 36,095 euro, a difference of 8,315 euro. So based on this calculation, leveraging your portfolio will earn you an additional yield of 8,315 euro over the period of 5 years if you have enough cash flow per month to cover the loan repayment and the interest. So as I said, this makes sense only if you have a really solid monthly cash flow and are planning to invest on a monthly basis. If you're investing only €100 or smaller sums per month and your monthly cash flow isn't that high, the strategy can cause a lot of trouble. When talking about troubles, leveraging your investments as a retail investor should be approached with extreme cautiousness, and I firmly believe that there are certain requirements that should be met before taking the leap and taking a loan to invest in loans. So here are the requirements that I came up with and that you should definitely consider. So first, the expected yield from your investments is higher than the cost for your loan. This is an absolute must in order for you to make a profit. Next, you need to secure a cheap loan. Ideally, you have no other debt in your name, like credit card debt or a mortgage. The thing is that the more debt you have, the harder is it going to be to get a cheap loan. Also, the higher the debt, the higher the chance that you will fall into a debt spiral. Another requirement is that you are an experienced investor and confident in making the right choices. If you are just starting out with P2P lending, don't even think about leveraging your P2P portfolio. The risk that you will lose money is quite high. What you should also be able to do is to estimate the risk-adjusted returns, or in other terms, evaluate individual business models and investment projects. You should also be able to evaluate external risk and the impact on your portfolio. What I'm talking about here are external macroeconomic factors like political risks, the economic downturn in certain countries, moratoriums during a recession, etc. When leveraging, you should also be regularly monitoring your portfolio. Investing once and then rest for the next 5 years is not the right way to go about it. P2P lending has changed over the past 5 years and it will certainly evolve in the future as well. Another requirement is that you spread your investments across multiple loans from different borrowers and different locations to minimize the default risk. Putting all your eggs into one basket, aka all your money into one project, is very risky. As mentioned before, you should have enough monthly income to cover the debt repayments, which consist of principal and interest. If you don't, then stay away from taking a loan. You also have to conduct very thorough due diligence. Our due diligence workbook will help you to reduce the risk of investing in fraudulent platforms, but you should also look beyond and invest only in regulated, well-established P2P platforms with a solid track record. Ideally, you have also made your own experience with the platform before investing with leverage. To decrease the risk, the preferred platform should offer loans secured by collateral, ideally with a secondary market, which should help you to decrease the loss and exit your investments in the worst-case scenario. So these were the main requirements that you should consider when thinking about leveraging your portfolio. It is crucial to not miss any of those, as it can result in a debt spiral and then you are in real trouble financially. What you should be considering are also the risks that come with P2P lending. So here are some of the risks that you need to be aware of. What you are doing is basically leveraging already leveraged assets. As you know, the lender is taking debt from P2P investors to finance the debt of borrowers. You should also understand that banks don't want to take the risk and fund those loans. You are not only bearing the risk for your own money, but you are also responsible for your debt. If the borrower doesn't repay the debt to you, you won't make any profit and the plan won't work. That's also why it's crucial to have enough monthly cash flow and not rely on repayments from P2P investments to cover your own loan. So basically, when leveraging your portfolio, you also multiply the risks. You still need to repay the loan even if the lender, the platform, or the borrower defaults. Also, the chances of retrieving money from defaulted or suspended loan companies in the consumer lending sector is rather low. This means that you should prioritize secure debt for your 5-year leverage plan. Investing in payday loans can be risky, as you might have experienced last year on Mintos. The average yield for well-diversified portfolios was only 0.95% and many investors actually lost money. So if you would invest in Mintos with a loan last year, it would likely put you in a very tough spot. This means that if you think that you will just invest on the largest P2P marketplace and hope for the promised returns, you might get disappointed. The question remains, should you leverage or not? Well, in my opinion, retail investors, especially those who don't have enough experience and knowledge about P2P lending, should not take the risk and leverage their portfolios. Leverage is obviously very attractive, but it can be also very risky. If you are not a professional investor, the risk is often higher than the potential return. Also, if you invest just a few thousands of euro, it's not really worth the time investment, in my opinion. You need to do a lot of research and you are also spending more time on monitoring, and you might also experience more stress as you are not really in control of all the risks. What you should know is that if you invest as a private individual, you cannot deduct your costs for the loan when doing a tax return, which would be otherwise possible in many jurisdictions if you, for example, invest as a company. So the risk and return ratio of leveraging your P2P portfolio is also often influenced by the taxes that you have to pay on your capital gains. Some countries offer low tax rates, while in many countries you have to pay between 20 and 30% in taxes, which obviously reduces your net return as well. So after all those considerations, I think that most retail investors should not leverage their P2P portfolios. It is really more suitable for higher net income individuals or professional investors. So this video should definitely not be seen as a piece of investment advice, but rather an educational video about when leveraging makes sense and what are the requirements, as well as the risks that you should consider. If you're wondering whether I leverage my P2P portfolios, the answer is no. And the reason is not because I would not feel confident in making the right choices, but because my income isn't as high to be comfortable with the associated risks. That's been my take on leveraging P2P lending portfolios. I hope you have learned something from it. Let me know what you think about this strategy in the comments below. So that's it from me today. Thanks for watching, and I will catch you in the next video.